The Money Show.
Personal Finance with Warren Ingram.
Occasionally, we go through a period where there's a lot of good news. And very occasionally, we go through a period where there's a lot of good news, and Warren Ingram is live and in our studio in person. He's a certified financial planner at Galileo Capital, and here he is. Warren, it's wonderful to see you. Good evening.
So good to be in studio in nice kind of rainy Joburg. It's wonderful.
You're taking refuge from the heat of the Western Cape. Got a jersey on and everything to rub it in.
I'm not used to this.
Okay, we're going through some good times. The question tonight is, how do you capitalize on that? And I suppose it's fair to say that in some ways we're so used to kind of negative news, which is often what news is for various reasons, that it's quite strange to sort of think that actually some things are going very well.
And I don't think we necessarily stop and take stock of, we've arrived here, can we remind ourselves where we were and what we were not complaining about, but what were we worried about 1, 3, 5, 7 years ago? And I'm just thinking, when last did you sit around the braai or the dinner table complaining about load shedding? We don't do it anymore. And the unemployment rate is rising, and the economy is not doing anything, and the country is being badly managed, etc., etc. And we're ingrained to do that anyway. But we should stop and just take a second to look where we are. And for me, a couple of things happened. We gave it attention. We've given it actually attention on this show, but I'm not sure as a country we gave it enough attention. And so things like getting off the grey list. I've had so many people say to me, we shouldn't have been on it in the first place. Of course, that's true. But we're off it. And we did it not necessarily in record time, but actually one of the quickest turnarounds. And then you add to the fact that we're starting to balance the books as a country. When you talk about an individual and you say, please stop spending more than you earn every month. Well, we were doing that very successfully as a country. We were spending a lot more than we were earning. We actually now are spending less than we're earning when you ignore the interest cost. When you add the interest cost, it's not such a pretty picture. But that's called a primary surplus. We're making a primary surplus again, so it's now the second time, and I think we're on track to do it for the third time. Then we get to this blessed budget. And firstly, the budget goes through without a fight.
Yeah.
It happened. If there was fighting, you and I didn't hear about it. It wasn't splashed all over the news. Maybe you heard about it. I didn't hear about it. Seems to me largely a consensus, like that actually our government is pulling in a direction, and it's what I would call a responsible direction. Again, we're spending less than we're earning. We're allocating money correctly, more so as time goes on. And we add into something into that budget of, by the way, we actually think this 3% inflation target is a good thing. Almost like a by-the-by thing.
Yes.
There was a bit of a spat, and now there's not. Then we get Standard & Poor's saying, we think you're doing a really good job. Actually, we're going to upgrade you. So we're still below junk, but we're going to upgrade you. And we think that the momentum for that upgrade is positive. In other words, there is room for more upgrades in the very near future. All of this has happened in a reasonably short space of time. All of it is incredibly positive.
It's also all about momentum, right? It's not about the numbers. It's about the trend, the direction that you're moving in.
Yeah, I think I couldn't remember if I mentioned about unemployment. Unemployment is slightly less bad.
Yeah.
Another positive thing. So what we've got now is that kind of stone that's rolling down the hill. All that's happened is it's fractionally moved. It's got momentum. And what we need to know is momentum has worked against us for a very long period of time. Almost kind of 2007 was the last time we had really good economic news. Now we're having it again. And if you just keep doing the right things, that momentum starts to build. And I think that's where we are now. And it's not just you and I looking at this and going, that's okay. The rest of the world looks at that and goes, ratings agencies, they're not the most exciting people, right? Like they're not there looking at the positive outcome. They're looking at what could go wrong. And they're saying we're doing things well. Things are going well and should carry on. That for me is very good news.
There's a big issue around the rand and the new inflation target of 3%. Why is that so important? Because it keeps the rand at a certain level and basically keeps it stronger?
It does. Just to be clear, like the intent is not to manage the rand.
Yeah.
The intent is the country and the people that manage the books of our country, so the Reserve Bank and our Treasury, are saying we are showing the world that we are fiscally disciplined, that we are actually restrained in our spending, and that we can control inflation. If we do that, one of the things that causes the rand to get weaker against the dollar, for example, is if our inflation rate has been 6% for a long period of time and theirs has been 2% for a long period of time, that difference, that 4% difference will be the amount that the rand will weaken against the dollar. When you ignore all the politics and all the other things that could go wrong, that would be a guarantee. So if we get to 3% and they seem to be struggling to break 3%, that means we're both at 3%. That's one thing that keeps the rand at a level to the dollar. We'll still weaken because we're a small economy, politics are not great and all those things. But a strong rand means we don't import inflation with oil, with food, and that's a big issue. So we import a lot of petrol. We don't have our own. And we import a lot of food, surprisingly. And those things cause inflation. So if you're paying in dollars for those things and the rand is now stable against the dollar, you don't have as much inflation. Again, positive news.
Okay, it's 18 minutes now to 8 the time. You know the number, 011 883 0702 021 446 0567 and voice notes on 072 702 1702. Your questions for Warren Ingram tonight. That's all the good news that's happening. How you make money from it. And the first thing, I just want to check this, Warren, because I know you'll know the answer. We are now going to have lower inflation, which I presume means that over time, so if we say over the next 20 years, we should have lower interest rates, which I'm hoping means that I would pay a lot less interest on a bond that I started now than I started 20 years ago.
Yeah. So the reason we have high interest rates right now is it's the main tool and almost the only tool that the Reserve Bank has to control inflation. If inflation's under control, that means the Reserve Bank can start to cut interest rates. If they cut interest rates, that means that you and I pay less on our debts. It also means the whole country pays less on its debts because we as a country, we issue a government bond. We have to be attractive to everybody, South African and global investors, to offer them a good interest rate above inflation. So if our inflation rate is low, and that means instead of issuing a bond at 11%, we might issue it at 8%. It's still a very attractive rate for investors above inflation. But you and I are spending less on debt, which means hopefully that we pay our debts down, and that means that we've got more money to spend on the economy, in the economy. So on building houses, all of those things. Lower interest rates are extremely positive for the property market, for every individual who owns a property or wants to own a property. Also for, unfortunately, things like extra spending. So now people will spend more on the things that they don't really need, but it's actually positive for the economy if we're not spending it on useless things. So we can actually create a positive economic spiral that causes better unemployment. You get the picture.
Okay, so then all of these things mean that there would be quite a lot of positive news over the long term because this is where the long term matters. But it's good news for businesses too if they want to borrow money to expand.
Yeah. So when you're paying 10 or 11% a year to grow your factory or to build a new building, 10 or 11% a year, most businesses would be thrilled to grow their whole business by, let's say, 15% a year. When you're giving away most of that just in interest, it just doesn't create scope to really invest properly. But if you're borrowing at 8%, it creates more scope to actually grow and grow. And that's what we want. We want businesses to grow so they employ more people. So lower interest rates caused by controlled inflation have a huge economic impact, but not tomorrow. So it's something that sustainably, incrementally causes the tide to turn.
You spoke about ratings agencies. Now, presumably they see this. If they then give us another, and going into this with S&P Global, they gave us the upgrade. The others haven't yet. But there was a lot of speculation. They didn't give us one now. They would give us one next year.
Yeah.
So they gave us one now. That doesn't necessarily mean they'll give us another one next year. But the others will sit up and take notice of that. What happens then if they all follow and we start slowly getting rated up?
Let's say, which is not unrealistic. I'm not saying we'll jump from 3 levels or 2 levels below junk to immediately in February. Now we're at investment grade. But that path to getting to investment grade is much shorter now than it was in the past. If we get to investment grade, that means we get onto global bond market indices, we get onto global stock market indices again, et cetera, et cetera. So now we start to attract money simply because of momentum. Back to the M word again. Momentum is in our favor here. So we get onto a whole lot of radars of the bond fund managers as well. And just global investors would be looking at this and saying, okay, you're investment grade. So if I'm a global manager and I've got to allocate money to places, I don't really get fired when I allocate money to an investment grade country. Allocate money to a junk status country and it doesn't go well, I get fired. So your risk appetite improves when you're buying investment grade countries. There's a lot of human behavior behind this. And then global businesses would be saying, okay, we can build factories there. We can build our operations down there as well. So investment grade for us is a huge thing. Like, that's the thing we're really aiming for.
Okay. I mean, I remember the terrible headlines, South Africa now junk, when it all happened in 2017 and 2015 in December and all of that. All of this then, if we get some economic growth, it starts to spiral. What happens then? I mean, that obviously does things for the JSE, which is having a record time, even though a lot of the stocks that are doing very well are kind of earning money in dollars and are related to gold.
Yeah, so let's talk about the growth. Everybody's kind of forecasting that the country generates 0.9 or 1.1% economic growth. They call it GDP growth. If we get something slightly faster than that, where the good news does compound slightly, that means we start to absorb more and more people who are unemployed into the employment sector. Our population growth is not much more than 1 or 2%. So if you're actually absorbing people into the employment, where you're growing employment faster than your population is growing, all of a sudden, the whole country gets a little bit richer per person. So that's GDP per capita. That's the jargon. That is the golden, like the holy grail of everything. You want to get to that point where you start to make everybody feel a bit richer every day, and that they see hope. What we know is, if you have hope, all of a sudden you start to invest better, and you do look at the long term. You do build a house, you do build a business, you do educate your kids in the country. So you break that really bad spiral that we might be coming out of now.
And that will also partly come over time because of a lower inflation target, because the interest rates in the end will be lower.
Yeah, I mean, I didn't appreciate, I had to spend some time with bond managers to understand that this inflation target, almost like the announcement of it, on its own wasn't something, but now the Treasury is agreeing, and the Reserve Bank agreeing, and actually that people see we're sticking to it in our budgets and the way we're doing things, means that immediately, almost the very next day, when we issue new bonds or we're refinancing as a country, we're paying less interest already. So it had a very positive impact. We are not going to spend as much on interest as we have in the past, which means we can pay down our debt faster, which hopefully means we can invest as a country in more infrastructure, the things that create jobs.
We're speaking to Warren Ingram tonight, a certified financial planner at Galileo Capital. There's a question as well, and it's asked, and it says, Stephen, I'm changing jobs in the next month, so I have some money in my provident fund. I can draw a chunk of it as a resignation benefit. I have some credit card debt that I would like to settle. Should I use my provident fund money to settle this debt? Is from Tony. Tony, we'll have an answer for you in just a moment.
The Money Show. Personal finance with Warren Ingram.
Well, your questions for Warren Ingram tonight. John, I do see your call. We'll be with you in just a moment. First, Warren, Tony's asking, I'm changing jobs, have some money in my provident fund. I can draw a chunk of it as a resignation benefit. I have some credit card debt. Should I use my provident fund money to settle the debt?
I mean, I really don't like that as an option. I think, you do that when you've just run out of all other runway. So when you're cancelling or taking money out of your provident fund, you're paying big taxes on that, so you're already going backwards, and those taxes are probably higher than what the interest is that you'd pay. And all the growth that would have been in your provident fund growing tax-free, now you lose that. So you lose the tax-free growth and you pay a lump sum tax. So I think unless you're going to lose all your assets because you're going to be foreclosed or something, they're going to bankrupt you, the credit card company. If you can find another way, please do that.
Okay, so just keep the money in the provident fund, Tony. Over the longer term, it'll be worthwhile. All right, John on the line from Craighall Park. John, good evening. What's your question? Go for it.
Yeah, good evening. I've heard all of the advantages of a lower interest rate. What is the disadvantage, or why don't they set the inflation target as zero?
It's a great question, eh?
At zero.
Yeah, thank you.
All right, thanks, John. He's going to listen on the radio, Warren. Yeah.
John, your example is probably Japan, actually, because you do want a little bit of inflation because it's a sign of a growing economy. When you have zero inflation, you open the option for deflation, where for example, things constantly get cheaper. So that sounds like an amazing thing. But if things are getting cheaper, it means companies are making less money. It means they've got less money to pay salaries. They've got less money to invest in the country, the company. Everything goes south. So you actually want a little bit of inflation, but it needs to be under control, and it needs to be reasonably small and reasonably stable. Then all of a sudden you get this positive spiral. But a zero inflation rate, I know it sounds good for most of us who don't want our food prices to get higher, but actually you want a sign of growth. You want things to get better and bigger. And I'm talking about economics now. And so a little bit of inflation is kind of your perfect point. 2 or 3% is ideal. That's what most of the good developed countries have.
You actually have deflation in South Africa in some goods. So some appliances, bicycles, for example, nice bicycles. If you buy them now, they're cheaper than they were 10 years ago. But that also means that if, for example, a bicycle is going to be cheaper next year, you're not going to buy it now, you're going to buy it next year, which means there's less economic activity.
And imagine that on a very large scale where you're a business that says, well, we need to buy 100 million rands worth of machines. If we just wait.
Yeah.
It stalls.
The other thing that I suppose we need to just talk about is that there is a short-term pain to a lower inflation target because interest rates will be slightly higher for slightly longer.
Yeah, and so that is like we're taking our medicine. We have been taking our medicine anyway. We're taking our medicine now, but what the hope is 1 or 2 or 3 years from now, we're seeing a very positive picture. So it does send, again, momentum and a signal. It sends an incredibly good signal, but we need to let it unfold.
Okay. We do need, with all of this good news, and let's just go back to that main theme, you do need to maintain a balance, right?
Yeah, I kind of want to highlight to people, we've heard these comments out there like, a couple of years ago, cash out all of your South African stuff, send everything overseas. So that was the very opposite of the conversation we're having today. And if you think about that, the JSE in dollar terms has been one of the very best stock markets in the world. And so that pain of people who've sent all their money out, they're suffering now. And equally, they sent it out probably at 19 to the dollar, and we're sitting at 17 something to the dollar. That's all bad news. So I think I'm highlighting this to say you always need to. I know you always tease me about diversification, but this is it, right? We're living it now. We're seeing the benefit of having money in South Africa and overseas. So I'm not saying sell all your overseas investments, bring everything back to South Africa, but if you've been underinvested in SA and you need to get your balance right, think about that actually interest rates are coming down in South Africa. Economy's still going to grow. The JSE is still going to do well outside of just the dollar earning commodities businesses. There is scope for growth. So make sure that balance is right because it can be a very profitable decision for the next 5 or so years. And so that's all we can kind of look at the moment. And if that positive spiral carries on, who knows? So I'm not saying bring everything back to South Africa. Equally, I never said send everything out. And I think we've got to make sure we use this as an opportunity to get that balance.
So I mean, this could be a moment if you have taken everything out, you want to get back in kind of now. Not all of it, obviously, but quite a lot of it, or some of it. And you also want to be able to say, you also want to sort of know exactly. Well, it's a complicated thing, but you don't know what's going to happen. But you do need to take cognizance of the change in momentum.
Yeah, and understand that that's going to impact, for example, the bond market. It's going to impact the property market. We all know, like Joburg has had a very tough time from a property point of view. I'm not predicting that it's now just turned and everything's going to be better, but there are early signs. And if the momentum is positive, and you were sitting on the sideline saying, I need to buy in Joburg, I need to buy the family home. Think about it now. Get that balance of your assets correct. As you say, if you need to bring in some money because you're out of balance, get that right. Equally, don't stop sending money out if you're a bit low on your overseas side just because things are going okay at the moment. We don't know what's going to happen in 3 years' time. We don't have that crystal ball, but we need to be ready to benefit from all sides of the story.
I've had people tell me that Joburg's off the bottom for the last year, which I find very funny. There's also a sense of a mood. Right? If things start to look good and government is sending quite a big signal with an inflation target, with other things, that also means people invest, and that also means that we get a bit more encouraged to keep some money here, to put more money in, things like that. And that sentiment, and Adrian Gore spoke a lot about it, that sentiment in the economy is really important.
Yeah, and it's interesting you talk about Adrian Gore. So, I mean, he's been one of the people beating the positive drum for a while. And I think because he was positive for so long, maybe he kind of became muted by people saying, oh, you always say that, you're always positive. But we're hearing more and more positive voices from people that maybe weren't so positive in the past. So positive sentiment, again, it's a momentum thing. You get people to look at the future and say, actually, South Africa has a future. That's important.
Warren Ingram, it's great to see you as a refugee from the heat in the Western Cape. I really do appreciate it. And such an interesting topic, actually, because there really is quite a lot of good news around at the moment. You need to make the best of it, particularly when you're investing.